You've probably heard about Warren Buffett's annual shareholder letters, right? They're legendary, packed with timeless wisdom on business and investing. So today, we're going to crack open his 1993 letter and pull out 5 powerful ideas that are just as crucial now as they were back then. Let's get into it.
First off, why should we even listen to this guy? Well, how about this number for a start? From 1965 all the way to 1993, Berkshire Hathaway's book value per share grew at a compounded rate of 23.3% every single year. I mean, that's just an unbelievable track record. And yet Buffett himself is the first one to tell us, hey, don't just look at that number. And here's the hook. Right after he drops that incredible growth rate, he immediately pivots. He says, look, book value, that's just an accounting number. What really truly matters is intrinsic value, the actual real-world earning power of a business over its lifetime. And that one simple idea, it's the foundation for everything else we're about to talk about.
So to really get inside his head, we're going to break down 5 big themes from this letter: how he actually measures success, his very unique approach to buying companies, the financial jet fuel that is insurance float, his radical rethinking of risk, and finally, the almost unbelievable power of just holding on.
All right, let's kick things off with our first big idea, looking way beyond the simple bottom line to figure out what truly makes a business tick for its owners. So what's the real difference here? Well, think of it this way. Book value is what the accountants say a company is worth. It's a formula. Capital in, earnings kept, and so on. But intrinsic value, that's what a business owner actually cares about. It's an estimate of all the cold, hard cash you can pull out of that business for the rest of its life. And believe me, those two numbers can be miles apart.
And to really hammer this point home, Buffett pulls out this classic quote from his mentor, Ben Graham. See, the market's daily votes, that's all about popularity, emotion, what's hot right now. It can be completely irrational. But over the long haul, the weighing machine takes over. Eventually, the market price has to reflect the company's true underlying weight, its value.
Okay, so focusing on long-term value sounds great in theory, right? But how does it actually work in practice? Well, that brings us right to our second theme: how Berkshire actually goes about buying businesses. And spoiler alert, it's not some crazy, complex formula.
His criteria are almost shockingly simple. First, the business itself has to have solid economics, somewhere on the scale from good to terrific. And second, the people running the show, they have to be terrific to terrific, no exceptions. The whole game is finding both of those in the same package. And back in '93, he pointed to Dexter Shoe as the perfect example, calling it one of the best managed companies he'd ever laid eyes on.
And this line? It just brilliantly sums up his philosophy after he buys a company. He finds these amazing managers who've built incredible businesses, and then he just gets out of their way. He trusts them. It's their baby. They built it, and he thinks it's completely absurd for him to come in and tell a superstar how to do their job.
Okay, now we get to one of the real secrets to Berkshire's success. I'm talking about the absolute magic of what's called insurance float. This is the financial engine that gives Buffett the capital to go out and make all those investments.
So what exactly is float? Well, the simplest way to think about it is it's other people's money. See, when you pay your insurance premium, the company doesn't usually have to pay that money out in claims right away. They get to hold on to that cash, your cash, sometimes for years. And that giant pool of money they're holding, that's the float. And they get to invest it for their own benefit.
But here's where it gets really mind-blowing. Take a look at the cost of that money. In 1993, Berkshire had over $2.6 billion of this float. And because their insurance businesses were so well run and actually made a profit on the policies themselves, the cost of all that capital was less than zero. I mean, stop and think about that. They were literally being paid to hold and invest billions and billions of dollars. It's just incredible.
All right, this next idea, this might be one of Buffett's most important and maybe most controversial contributions to investing. It's all about how he completely redefines the very idea of risk. So let's just ask the question straight up. What is real investment risk? Is it just when a stock price jumps up and down like a yo-yo? Or is it something deeper, something else entirely? So Buffett lays out 2 completely different ways of looking at this. On one hand, you've got your textbook finance definition. Risk is volatility, measured by this Greek letter called beta. Buffett thinks that's just nuts, absurd. For him, real risk is much simpler. It's the possibility of loss or injury, the chance you will permanently lose your capital. A great business whose stock price is bouncing all over the place? That's not risk, he says. That's an opportunity.
So he basically tosses beta in the trash, and instead he asks these 5 fundamental business-focused questions to figure out the real risk. And just look at them. Not a single one has anything to do with the stock chart or market trends. It's all about understanding the business, the management, and the price you pay for it. It's a judgment call, not a math problem.
And when you think about risk this way, it leads you to a really surprising, kind of counterintuitive conclusion. For investors who actually do their homework, putting a lot of their money into just a few businesses they understand inside and out can actually be less risky than spreading it all over the place. Why? Simple. It forces you to be so much more disciplined, to think so much harder, and be so much more certain about each and every investment you make.
And that brings us to our final big lesson from the 93 letter. And honestly, this might be the most powerful one when it comes to actually building wealth, the simple and wildly overlooked power of just holding on.
Buffett tells this great little story to make his point crystal clear. Okay, picture this. Scenario 1. You start with a single dollar and you make a series of great investments, doubling your money 20 times. But you pay a 35% tax on your profit every single year. You end up with about $22,000. Not bad, right? But now scenario 2. You hold one single investment that compounds on its own, and you only pay that 35% tax once, at the very, very end. The result is just astronomically different. This is the raw power of tax-deferred compounding.
So the conclusion here is incredibly simple, but so important. If you're jumping in and out of stocks, even if you're making profitable trades, you are getting killed by taxes. It's a massive anchor dragging down your long-term returns. The real life-changing wealth is built by finding a wonderful business and just letting it compound for you year after year after year.
All right, so let's boil it all down. What are the big takeaways? First, measure a business by its real long-term earning power, its intrinsic value, not by the crazy daily stock quote. Second, remember what real risk is. It's not a bumpy stock chart, it's the chance you could lose your money permanently. And third, think like a true business owner and harness that incredible, almost magical power of long-term tax-deferred compounding. And all of this really boils down to one final question, a question that Buffett's entire philosophy forces you to ask yourself. Are you truly an investor, focused on the long-term value of a business, or are you a speculator, just betting on which way the squiggly line on a chart is going to go next? As Buffett shows us, the answer to that question, well, it makes all the difference in the world.